Hello, here's a review for practice questions for chapter 1, 2, 3, and 13. Let's walk through all the questions. Question 1, what assets generate net income to the economy? And what assets define the allocation of income among investors? I think this is the direct definition between real assets and financial assets. So it's A. So real assets generates the net income to the economy, and financial assets defines the allocation, the claims of the returns to the real asset. Moving down, on a given day, stock dealer maintains a bid price of 1,050 cents for a bond and an ask price for $1,003.25. The dealer made 10 trades that total 500 bonds traded that day. What was the dealer's gross trading profit for this security? All right, so let's calculate that. So the dealer, they basically extract the bid-ask spread. Now we have an ask, which is $1,003, and there is a bid price, this. So this is the bid-ask spread. Bid-ask spread equals to this. 2.75. And the bid-ask spread times the number of trades will be the profit of the dealer. So number of trades is it has made 10 trades that total 500 bonds traded. So this price is per bond. So bid-ask spread is per bond. So if the dealer process 500 bonds, then it's the bid-ask spread, the price per bond times number of bonds equals to 1,375. All right, so that is C. Question 3. The material wealth of society is determined by the economy's what, and which is a function of the economies of what? Again, this is the definition of a real asset and financial asset. The material wealth of the society determined by the economy's productive capacity. So nothing related to investment banker. So productive capacity, which is a function of the economy's real asset. Real assets can generate production capacity. Financial assets only defines how people allocate and share the return. Okay, so 4, what are the examples of financial intermediaries? I think commercial banks, they are the middleman. They are the belongs to the financial sector, and if they are financial sector, usually they are intermediaries. Insurance company, they are intermediaries. Investment companies, they are intermediaries. Moving down, which of the following is an example of financial intermediaries? I think similarly, if it's as long as it's not a corporate, the firms outside of the financial industry, I think those are all financial intermediaries. So you just need to spot whichever amount this for is not the financial firm, and that is IBM. 6, a major cause of the mortgage market meltdown in 2007 and 8 was linked to securitization. I think we covered it in class, that subprime mortgage, so some very high risk mortgage that, the lender, the borrower has high risk of going bankruptcy, being default. Those are called high risk. Those people who borrow money and couldn't pay back. So then that means the loan has high risk. And during that time, before 2007 and 2008, a lot of financial company will sell and package those loan and sell it as a security. So it basically creates some more risk out there. So that is called securitization. They securitize the very risky loans. Go down. The Vanguard 500 index fund tracks the performance of S&P 500. To do so, the fund buys shares in each of the S&P 500. In what ways? So in proportion, so this is actually testing your understanding of how to construct S&P 500, how S&P 500 is being calculated, and we talk about it. So there are several ways: equal weighted, value weighted, and dollar weighted. And most of the index, including S&P 500, is value weighted. So value weighted means that it is proportional to the market value weight of the firm's equity in S&P 500. And A here. What stock prices are what measures of firm value? It's a forward-looking measure. I think we talk about it in class, but I think I can emphasize it here that the stock prices, including the market index, is a leading indicator for what is happening in the real economy. So investors, they want to look at not just the current profitability of the firm, they are also always continuously adjusting their expectation towards the future earnings of the company. They are not just investing to the present time, they are also investing in the future. So therefore, anything related to the future growth of the company will be priced in if it's relevant and material. So that means that the stock price reflects all the information out there, and the information could be related to the future growth or future risk associated with the firm. So that means price is a forward-looking measure, a reflection of expectations. So 9, in what industry are investors likely to use dividend discount model and arrive at a price close to the observed market price? So I think in the class, I have 2 of you read the end of chapter questions. Basically, that questions explains what firms are suitable for dividend discount model, and those are mature firms. Mature firms with stable growth are more suitable. Every firm can, as long as it pays dividend, every firm, you can apply the dividend discount model to every firm that pays dividend. But there are more accurate and versus a less accurate estimation of the company's intrinsic value when you use dividend discount model. So model is a dead model. It's their formula, you plug in numbers. But the output, you need to look at it case by case. Because the model assumes companies pays fixed dividend. Company's dividend is growing at a fixed rate. And that is not necessarily true for all the firms that pays dividends. So which average firm in the industry that very likely pays a constant dividend, and the dividend grows at a constant rate, that will be a company with which is in the stable, mature age of the business cycle. So comparing to software, comparing to telecom, which is also a tech sector, I think utility is relatively more stable and mature. And this is import and export trade. I don't think this is an industry. Moving down, a bond issued by the state of Alabama is priced to yield at 4.5%. If you're in the 20% tax bracket, this point would provide you with an equivalent taxable yield of what? So starting from this point, I think these are all numerical questions. And it basically require us to calculate. So I'm going to pull up the formula. All right. Formula. Come over here and let me scroll it down to the formula for calculating equivalent taxable yield here. We have tax-free rate here, tax-free bond yield, and the tax bracket 20%. So we want to calculate R taxable. R taxable equals to, I need to rearrange the formula, tax, oops. It's divided by 1 minus tax rate. So it's 4.5 equals to 4.5% divided by 1 minus 20%. So which is 4.5 divided by 0.8. And that gives us 5.63%. So equivalent taxable yield is 5.63%, and you can see that is higher than 4.5. But for this person with this tax bracket, 20%, if this person invests into Alabama's state, the municipal bond at 4.5% is equivalent of investing into any corporate bonds at 5.63%. So if there's a corporate bond that gives a yield that is higher than 5.63%, then definitely choose those that has higher corporate higher yields that is larger than 5.63%. If there is, yeah, so that's the idea. Moving on, the person is very bullish about the stock and want to buy as many shares as possible. The current stock price is 12.5 and they have 33,000 to invest. The initial margin is 50%. What is the maximum number of shares? So 50% and the person has 33,000. So 33,000. So that means this person can borrow 33. So let's see. So this person can buy them various different way of calculating this. I'm just using my way. If you got the same number, then your way is also correct. Divided by 12.5, so that is 2,640 shares. And because initial margin is 50%, so this person can borrow 33. And this is own investment. Borrow 33, so because it can borrow 50%, so they add up to 100. And borrow 33 means that it can further and further buy, further buying this amount of shares, 640 shares. So a total equals to 40 times 2. So it's 5280. All right. So that's my way of calculating it. I think there are more straightforward way, which is, when you got this, you just times 2. So that is the total shares, the maximum number of shares that the investor can buy with the initial margin equals to 50%. And next, the person purchased 200 shares of the stock on margin at $50 per share. Assume initial margin is 50%, maintenance margin is 30%, and the investor will get a margin call if the stock drops below. So we need to solve the price. We have, I think we have equity divided by market value equals to margin. So we need to calculate equity. And equity equals to market value minus borrowed. And the amounts that was borrowed, was purchase 200 shares at this, and initial margin is this. So amount borrowed is 50% times 200 shares times $50 per share. And that equals to 5,000. This is borrowed. Okay, and market value will be is 200 shares times P. Okay, so that is the setup, and the margin here equals to 30%. Yeah, so we went through the bio margin questions last time. Let me pull up the exercise. Homework 2, go all the way down. We have 2 methods. Yeah. I think it's in-class exercise. So you're using borrowed amount divided by 1 minus the maintenance margin. So good. So we want, so basically, so equity, the proportion of equity relative to the market value should equals to 30%. So that means that this part divided by market value equals to 30%. So that means borrowed amount divided by the market value equals to 70%. And we already know the borrowed amount, so we can back out the market value. So market value, therefore, market value equals to borrowed divided by the proportion of the borrowed, 1 minus margin. So 5,000 divided by 1 minus 30%. Okay, so this part represents the borrow amount here represents 70%, the equity represents 30%. So that is defined by the question, the threshold for maintenance margin here. And that is 5,000 divided by 0.7. 5,000 divided by 0.7, that is 7142.86. And then price, we can therefore solve for using the total market value divided by number of shares equals to 35.71 dollar per share. So the investor can buy, so in this case, investors bought at $50 per share. If the price further dropped to 35.71, then the investor will receive a margin call. Okay, move down. The company currently pays a dividend at 1.22, and which is expected to grow at a rate of 2.5 indefinitely. So constant growth for dividend, constant growth rate. And the current value, this is based on constant growth dividend model. The current value is 32.03. And what is the required rate of return? So we need to rearrange our formula. Our formula, do I have? Okay, I need to open up the formula for going from question 3, homework 3. And the formula is dividend discount model, looks like this. And currently the value is 32.03, and it currently pays 1.22. So that means that this is not a future dividend, because there's a hint. There's a keyword here. So we need to calculate 1 plus 2.5. This equals to if it's dividend 0. If this is dividend 0, then we can refine the model in this way. If we don't know D1, then we back out D1 with D0, applying the growth rate 2.5. Divided by, we don't know K. We're trying to solve for K. minus, but we do know G %. All right, so ladies and gentlemen, so solving right-hand side variable, so we need to isolate K. All right, so why not just simplify everything here? So let me calculate the numerical numerator here. So 1.22 times 1.025 equals to 1.2505. And then I just copy everything down. So I rearrange the formula so that this is on this side and this is on this side. All right, and K is on the left-hand side. And then I rearrange the formula. So there's only K on the left-hand side. All right, so then K equals to 1.2505 divided by 32.03. That equals to 0.3904 plus 0.25. And that is 6.4. 6.4. Right, so let me see if I calculated correctly. Double check again. 1.22 times 1.025. So 1.22 times 1.025 equals to 1.2505. And that this part is right. And 1.2505 divided by 32.03 equals to this 0.03904, correct. And that is correct. And then plus 2.5, I should give, yes, here. Plus 2.05 plus 0.025 equals to 0.064, and that is 6.4%. Okay, that is correct. Okay, moving down to 14, question 14. So you short sell 500 shares of this company, and now it's selling at 47 per share. And the person wants to limit the loss to 23.80, and they should place a stop buy order at. So amount received from short sale is 500 shares times 47 per share. And that equals to 23,500. And then the person wants to limit the loss, and the loss is 2,380, 2,800, 2,800, 380 equals to 500 times the price minus the initial preceding. So then we solve for P. So that will be this plus this and divided by 500 equals to P. So that's $51.76. Right? So when people short sell and the initial price 47, so they don't want to see the price further going up. They want to see the price further going down because they need to buy they short sell it now. So that means they sell the shares now. They got the proceedings from the broker. To close out the position, they need to buy, they need to return the broker with shares. They don't need to return the broker with money. They just need to return the brokers with the number of shares that they bought, that they sold. So therefore, they want to buy at a lower price so that when they return the shares, the cost is lower than the money they receive, the proceeding they receive from the broker. So in that way, this transaction makes sense for the short seller. If they need to pay even more to buy the shares back so that they close out the short position and return the shares to brokers, then it doesn't make sense for them to initiate the short sell position at the beginning if they don't project that the price will go down. But however, no one can precisely predict the direction of the future price. So if something went wrong and goes against their initial prediction, let's say in this case, if the price goes up instead of going down, then the short seller needs to pay $51 to buy the share back, so that they have shares to return it back to the broker. Then they realize a loss of $2,380. Okay, moving down. So this corporation is expected to pay a dividend of $3. So this is future dividend in the coming year. Dividends are expected to grow at 8%. The risk-free rate of return is 5%. Expected return 7%. I think this question is exactly this questions from homework 3. Right, so I don't need to repeat it. You can just double check homework 3 question for number 15. So go down. The corporation is expected to pay a dividend of $6 in the coming year, and then the dividend are expected to decline at a rate of 3% per year. And the risk-free rate is 5, expected return 13, and the beta is 5. Using dividend discount model, the intrinsic value of the stock is. All right, so the key here is G equals to a negative number, decline at 3%. So G, the growth rate is negative 3%. So in this case, when we're calculating the intrinsic value, I copy everything down here. And so first of all, I just need to change several numbers here. So risk-free rate is 5%, don't need to change that. Beta is 0.5. And then market portfolio 13% minus 5%, and that is 5%. 5% plus 13 minus 5, that is 8% times 0.5, and that is 4, equals to 9%. And then the D1 here is $6 divided by K, 9% minus negative 3%. And that equals to $50. Right, so if G is a negative number, you just do the same thing. Plug in G as a negative number. Don't change any other things in the formula. So then, if you minus a negative number, that equals to a positive number. So it will be 9% plus 3%. All right, so that's $6 divided by 12%. That equals to $50. Okay, finally, we have several questions related to Chapter 12. So countercyclical fiscal policy is best described by which of the following statement? Countercyclical fiscal policy. So fiscal policy is basically related to government spending, and countercyclical basically means that you want to do something against the cycle. Government surpluses are planned during economic boom, and deficits are planned during economic recession. This makes a lot of sense. I already spot the right answer. And so basically, when the market is doing well, economy is good, you want to restrict the spending because you don't need more. So the economy doesn't need more money. It's already in a good shape. So when the economy is in the recession, you want to spend more. So basically, going the deficit. So you spend more, such that you can stimulate the market. So by spending more, that means it generates deficit for the government. So B, the annual budget should always be balanced. This is not necessarily the case. So having some deficits is not bad for stimulating the market. Deficits should always equal to surplus. That is basically talking about the same thing. So like having a balanced budget. Government deficits are planned during economic booms and surplus are planned during economic recessions. That is not a counter-cyclical fiscal policy. So 18, in macroeconomic terms, an increase in the price of imported oil or decrease in the availability of oil is an example of supply shock. So oil is a material, one of the major and most important raw material out there for manufacturing and all other sectors in the economy. So moving on, if economic conditions are such that very slow growth is expected in the foreseeable future, one would want to invest in industries with, so the growth is slow. So how do we invest in that? So in that macroeconomic condition, we want to invest in the industries that with low sensitive to the economic condition because the underlying economic conditions is not good. So if you have huge exposure, you move very, very closely with the economic condition. When the condition is not good, that means you do not move. So you do not grow very well, so that the sector also grows at a very slow rate. So you don't want those industry. So you want some industry that is somewhere resistant to the overall economy. So you do need a below average sensitivity. For example, utility companies, for example, biotech company, those are not really following the economic cycle, those industry, those firms, you have people need to use the utility, the electricity anyway. You have to have people, there are always people who need medicine, or the development of, counting on the development of medicine. So those companies in the those defensive sector is not necessarily following the economic cycle. A top-down analysis of a firm's prospect starts with analysis of the what? Top-down. We're talking about top-down analysis. So top-down is going from a broad overview of the whole economy or the global economy, and then going down to the local economy, and then going down to the industry, going down to the specific firm. So it will start from US economy or even global economy. All right, so final two questions. The yield curve spread between 10-year bond and federal fund rate is a leading indicator. And this is the same question we cover in homework 3. An example of a highly cyclical industry is, so the industry which move closely with the whole economy, not utility, not pharmaceutical. These are the two opposite example. So automobile or tobacco. I think it's this A. So people buy more cars and the company sell more cars when the economy is good. So this is it's not consumer staples, it's consumer discretionary. So consumer, when they have more budget, they spend more on discretionary goods. So if it's staples, it doesn't, people have to spend money, same budget on food, on buying food. So those are relatively stable and not going to fluctuate with the cycle of the economy. But discretionary products like cars will be, highly cyclical industry. All right, so that is for the practice questions.